So, you ever wonder what's really going on behind the scenes with stock market returns? We hear about market risk all the time, but it turns out that's not even close to the whole story. All right, let's get right into it and uncover the hidden forces that actually explain why some stocks do well and others don't. For years, we've all kind of been taught to boil a stock's risk down to one single number, its beta. But does that really make sense? I mean, can you truly capture all of the different vulnerabilities of a huge company with just one number? Let's go ahead and challenge that idea. To really get the new way of thinking, we first have to unpack the old way. So we're going to start with that popular, but as we'll see, deeply flawed model that tried to make risk way too simple. Okay, so this traditional model is called the Capital Asset Pricing Model, or CAP for short. And the core idea is pretty straightforward. The only risk you get paid to take is the risk of the entire market going up or down. Everything else, all that company-specific drama, you can just diversify away. So your expected return really just boils down to how much your stock zigs and zags with the market. That's its beta. And this is where you can really see the cracks start to show. The theory says only market risk matters. But in reality, we see again and again that other things, like how big a company is or if it's a value stock, have a huge impact on returns. The theory assumes we all just passively hold the same big market portfolio. But come on, a small business owner's financial life is totally different from a tenured professor's. They need different things. So long story short, CAPM is a neat idea, but it's just too simple and, frankly, not very accurate. So if that one number model is broken, what's the fix? Well, the answer is realizing that risk isn't just one thing. It's actually a collection of multiple, kind of hidden forces we call factors. So what the heck is a factor anyway? Well, it's not just some random variable. It's a big, broad source of risk that you just can't get rid of, no matter how much you diversify. It hits almost every stock. Think of massive economic currents, like unexpected changes in GDP growth, sudden moves in interest rates, or inflation going haywire. These are the deep tides that are really moving the market. And with this idea, the whole model just flips on its head. Instead of having one beta for market risk, a stock actually has a bunch of different betas, one for each of these risk factors. You then build its expected return piece by piece. You start with the risk-free rate, and then you add a little extra reward, a premium, for each and every factor risk that stock is exposed to. It's just a much more realistic picture. This new way of looking at things is called arbitrage pricing theory, or APT, and it totally changes the game. It tells us that what drives a stock's expected return is its sensitivity to these big, broad factors. All that other stuff, the unique company news, whether it's good or bad, that's just noise. It gets canceled out in a well-diversified portfolio, so the market doesn't pay you a premium for it. At the end of the day, what really matters isn't which stocks you own, but which factor risks you're exposed to. Now, you might be sitting there thinking, okay, this sounds good in a textbook, but what actually makes it work in the real world? Well, the answer is this incredibly powerful force in the market that acts like a great equalizer. Let's talk about arbitrage. Arbitrage is basically the holy grail for a trader. It's a guaranteed, absolutely risk-free profit. It happens when the exact same thing is selling for two different prices. All you have to do is buy it where it's cheap, sell it where it's expensive, and you pocket the difference. It's the ultimate free lunch. Let's make this real with a quick currency example. Here, if you start with Canadian dollars and you cycle through Chinese yuan and US dollars, you actually end up with less money than you started with. So no free lunch here. But, and this is the key part, what if that last step gave you 101 Canadian dollars back? Well, traders would pounce on that in a nanosecond, and their combined actions would instantly push the exchange rates back into line until that opportunity just vanished. And that's exactly why these arbitrage opportunities are like a vacuum. The market abhors them and rushes to fill them instantly. Because of that, the only prices that can really stick around for any length of time are what we call no arbitrage prices. Prices where those free lunches just don't exist anymore. And here's the kicker. Here's how that locks our multi-factor models into place. If you have two different portfolios that have the exact same exposure to all the same risk factors, but one is promising a higher return, well, that's an arbitrage opportunity. That's a free lunch. Traders would short the loser, buy the winner, make a risk-free profit, and in doing so, they'd force those returns right back into alignment. Arbitrage is the cop on the beat. Okay, so we know these factors exist in theory, but what are they in the real world? Well, researchers have spent decades digging through mountains of data to find out. The biggest breakthrough came from two researchers, Fama and French. They figured out they could pretty much capture the effects of those big economic risks we talked about just by looking at a few key stock characteristics. So they kept the original market risk factor, but then they added two more. First was size, or small minus big, because smaller companies have historically done better than bigger ones. And second was value, or high minus low, for the simple facts that cheaper, unloved value stocks tend to outperform expensive, glamorous growth stocks. But why does this value effect even exist? This is where it gets really interesting. It's a huge debate. On one side, you have the rational story. It says value firms are just plain riskier. They have a lot of factories and equipment. They get hammered during recessions, so the higher return you get is just fair compensation for taking on that extra risk. But the behavioral story says no, it's an investor mistake. People get way too hyped about flashy growth stocks, they overpay for them, and they leave the boring value stocks in the bargain bin. The truth? It's probably a little bit of both. Now, the Fama French model was a huge leap forward, but it wasn't the final word. There was another powerful pattern in the data it couldn't explain: momentum. It's this weirdly persistent idea that stocks that have been winners over the last few months tend to keep on winning, and losers tend to keep on losing. This led to a fourth factor being added to the mix, often called WML, for winners minus losers. So we've got this really powerful new way to understand risk. But look, the most important question is, what do you do with it? How does this actually change how you think about investing? The single biggest shift you can make is to stop thinking about your portfolio as just a list of company names. Start seeing it for what it really is: a bundle of exposures to these underlying risk factors. Are you taking on value risk, size risk, momentum risk? Because that is what's really going to drive your returns in the long run. Let me give you a really cool way to think about this. Picture a retiree who has a secure pension. Their income isn't really going to change much in a recession, so they can afford to take on more of that recession-sensitive risk by loading up on value stocks. By doing that and collecting that value premium, they're basically acting like an insurance company. They are selling recession insurance to everyone else in the market. Now let's flip that around. Think about a young entrepreneur. Their income is super sensitive to the economy. So they might want to do the exact opposite: tilt away from value stocks to protect themselves. Yeah, they'll probably get a slightly lower return over the long haul, but that's the price they're willing to pay. In effect, they are buying recession insurance from that retiree. And this just changes everything. We're always told that active investing is a zero-sum game, right? For every winner, there has to be a loser. But when you look at it through this factor lens, you see a completely different picture. It can actually be a positive sum game. Both the retiree and the entrepreneur can make that trade, and they can both walk away better off. How? Because they each built a portfolio that's a better fit for their own personal ability to handle certain kinds of risk. And that really brings it all back home, doesn't it? This isn't just abstract theory. It's deeply personal. So instead of just asking which stock is going to go up, maybe the better question to ask yourself is, what are the underlying economic risks that I am most equipped and least equipped to handle? What hidden risks best describe your financial life?